Hey everybody, this is Jack Allwell with another money episode, and today we are doing a dive into the 4% rule. What is it? How is it constructed? And much more. So let's get to it. So many of you may not know what the 4% rule is, and many of you may have heard the 4% rule, but don't really understand the underpinnings of the concept. A couple weeks ago, we had the honor to speak with Jordan Grumet on our podcast, the Brothers on Books podcast. He brought up the idea of the 4% rule in his book, Taking Stock. I didn't understand the underpinnings of this concept. Said another way, take your living expenses, multiply by 25, and you should have the amount that you would need to retire confidently. If we do a Google search on what the 4% rule is, we get many results. One of the articles that came up was by Rob Berger, a man I've had the honor of share a Starbucks line with at FinCon, the shirt I'm now wearing. And he was the keynote speaker. So I thought this would be a good look into the 4% rule. So the 4% rule is easy to follow. In the first year of retirement, you can withdraw up to 4% of your portfolio's value. If you have $1 million saved for retirement, for example, you could spend $40,000 in your first year of retirement following the 4% rule. I thought this concept was 4% for all years, but Rob points out that you really should be adjusting the withdrawals by the inflation rate. And I think in an inflationary environment, we often don't really think of lowering the amount we would take out. So I guess I always thought it was 4% indefinitely. But he makes the good point that if prices are actually going down, this 4% rule, you'd actually be taking out less each year. Whereas he says in the rare case where prices went down by 2%, you would withdraw less than the previous year, $39,200 in our example. What were some of the findings from testing the 4% rule? Now, I don't know who Bangin is, but it looks like the 4% rule was kind of triggered off of some of the work he did. And he used actual market returns from 1926 through 1992. You can see that for years beginning in 1993, he assumed a 10.3% return on stocks and a 5.2% return on bonds. And so I can hear some of you guys saying, "What? That sounds really high for, returns on both of those." So let's read more. You can see further, he's basically testing whether the portfolio that was constructed can last the 50 years, taking certain withdrawal rates. And his findings were that initial withdrawal rate of 4% enabled most portfolios to last 50 years or more. One question I had was, what was the portfolio allocation mix of this portfolio that was used to test the 4% rule? By the prior mentioned, I would assume it's some sort of mix between stocks and bonds, but there's no mention to real estate, precious metals, Bitcoin in today's age, or cryptocurrencies. So these are things I wanted to know. So from here, we can see that Bangin adopted the assumption that a retiree's portfolio would be invested 50% in stocks, represented by the S&P 500, and 50% in bonds. Does this 4% rule really apply to me if I'm not using the same portfolio mix that is used in this 4% rule study? Some of his findings were a 3% withdrawal rate. All portfolios lasted to 50 years. 4% withdrawal rate. Most portfolios lasted 50 years. Retirement started in 10 of the 50 years examined fell short of this mark, although they all lasted about 35 years or longer. Okay, these are good things to think about. When examining other asset allocations, Bangin found that holding too few stocks did more harm than holding too many. Portfolios with 0 to 25% allocated to equity saw their longevity severely compromised. He also found the 50-50 allocation was optimal if the only goal was portfolio longevity. Now, we talk a lot about compound interest, but oftentimes neglect compound fees. What does the 4% rule or this study say about fees? Now, Rob Berger does say that Bangin did not take into account the potential for investment management fees, but alludes to the fact that very small fees will not affect Bangin's results. But if you are using a financial advisor, you should look into how much you're paying in fees, and we'll look at fees a little bit further into the video. One knock on the 4% rule that I've heard is that a lot of these 50-year periods overlap with each other, and it doesn't really address the question that you're really trying to answer, in the sense that if you are retiring at the top of a bull market versus, the middle of a bear market, how does that change your outcome? Because we don't have a ton of samples of, for example, the middle of a bear run. There aren't that many, and that's if you were retiring in October of 2022, you might be wondering, well, if I'm retiring in a bear market, what does that do with my chances of success? Now, Bengen did consider the downside risk of sequence of returns here, and by analyzing actual market data beginning in 1926, his results consider retirees who entered retirement during or just before some very difficult markets, including these three. Now, notwithstanding these market declines, retirees started retirement in or just before these years saw their portfolios survive for at least 30 years when following the 4% rule. So I went along here and am trying to construct potentially what the 4% rule is trying to tell us. So let's say we started out with $1 million. That first year, we're going to take out 40 grand and live off of that. We'd be left with 480,000 of both stocks and fixed income if we were going a 50-50 split, like is said in the 4% rule. Now, as an assumption, I just put what they had assumed at 5.2% for fixed income. I left it an easy inflation rate of 2%. I mean, we can play with that a little bit. So hopefully this makes somewhat sense. But so this would be the amount before you take the withdrawal of 40,800 in the second year. And basically, after that withdrawal, you would target this 436,896 for each fixed income and stocks. Then you would take this target. So you can see that when fixed income performs better than stocks, the 50% target would lead someone to say that the money should be coming out of the fixed income and going back into stocks. So here we see before the withdrawal was 409, but the 50% target after the withdrawal would be 436. So we're taking money out of the fixed income to pay for the annual expense and putting extra from fixed income into stocks. And you can see that, look, I mean, this one, it went up a lot. The second year, the stocks did. So money would come out of stocks since the 50% target is much lower, and would go into fixed income. So let's look at how this progresses over time. So let's make a chart. Let's see how this looks over time visually. So you can see here, like, fixed income is higher. So we take out some of that money and put it into the stocks. The stocks performed well. So then we take money out of the stocks, put it into fixed income, and it's kind of this balancing act over time. And let's look also at, here, let's also look at the total. So we started with $1 million, and we actually end up 20 years later at almost identical to where we started. So that's good that we are not in the negative. Let's see now what would happen if we had all these really bad let's see if I can just sort this and see how that affects the total after 20 years if we saw all those negative ones early. So let's see here, let's do a sort here. Let's go smallest to largest. So that's pretty interesting. See, you can see it goes way negative. I mean, I don't think this is super realistic, but here, let's go. Let's even just put this one at the front. Even just getting one good. We're still in the positive. Unbelievable, even with all these crazy negatives. Here, let's just put the, just playing around here. Sorry, guys. Hopefully you're finding this helpful to look at. You can see even if we do have a lot of negatives, since we are rebalancing, and this would be, so basically allocating more to stocks when stocks are underperforming. And intuitively, it kind of makes sense. Like, you know, you want to be putting money in if prices are low. So it's kind of interesting to think about. And now this also, Rob Berger mentioned that it doesn't really take into account fees. Now, if you were reallocating, you know, each year, that would incur some fees. I don't know how much, and depending on where your stocks and bonds are located, I don't know how easy that is to do. So that's something to think about. I want to look at fees real quick for you guys, so bear with me. So it's years. Let's look at 20 years and see how that looks with fees and without fees. Let's do over 30 years. Well, let's just do a simple, we're going to just assume a 5% return, let's say, each year. And let's say we start with, 100 grand. So with no fees, we're going to just level up each period. So that each new year's the prior year times 1.05. So we have $432,000 about at the end of 30 years. We just have 100 grand. Now let's say each year, wherever this amount of money is held, charges you a percent. So and let's say it's basically at the beginning of year. So here it's going to charge a percent. And so then we're going to increase by 5% each year, but then you're only going to get 99% because you have to pay a 1% fee. Zero here. But with no fees, with fees, let's look to see the difference over time in these two streams. 1% might not seem like a lot, but you can see it really compounds over time. And let's even look at the difference here. So the difference with no fees versus fees. So early on, it's just $1,000, but over time, we have given up $100 and almost $16,000 because of a 1% fee. That is pretty remarkable if you think about it. So that's why it's so important to look at fees, because we talk about compound interest a lot, but not a lot about the compounding of fees over time. Some of my takeaways from going into this 4% rule are, well, quite selfishly, I do not allocate my portfolio 50% stocks to 50% fixed income. I'm heavily into real estate. So I'm worried about how does real estate fit into this 4% rule and the idea of retiring. How could I transition from so heavy in real estate? Do I just keep the rental property? Should I slowly sell these and put them into well-diversified stocks and draw down that way? Also thinking about things I think you guys should be thinking about is, are you actually reallocating each year? Because if you're living by the 4% rule, you really need to get in the habit of trying to reallocate so you can be well diversified and weather these storms and buy more stocks when they're going down and vice versa with fixed income. One last thought, I would love to hear about your portfolio allocation and any ideas or concerns about the 4% rule. I want to hear what you guys think about it and how you are positioning yourselves to retire early. Thanks and have a great one.